Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
Gil Loria is Managing Director, Head of Technology Research at D.A. Davison and Company. He joins us from Detroit. Gil, nice to have you back with us. What do you make? First of all, investors seem to like what they got from Palantir. Break it down for us and what you see.
Yeah, they exceeded very high expectations. Their growth accelerated from more than 60% to more than 70%. There's no other software company even close. If you look at software companies 2 through 10, they're happy to grow somewhere between 20 and 30%, and they're usually decelerating. So what Palantir is doing is remarkable. We're running out of superlatives. It's remarkable, and it exceeds very high expectations that came in, which is what is implied by the valuation. That's why the valuation is so high on Palantir, is because there's no other company like it.
Yeah, I mean, the company said we are an N of 1. Do you agree with that?
Absolutely. Absolutely. The more work we do, and we cover 40-something other software companies, there's nobody that's even close to what Palantir can do. It's a very unique combination of skills. They have absolute ownership of their customers' data in terms of the ability to organize it in a useful way. They have an army of 4 deployed engineers that help companies solve problems. They have direct relationships with CEOs. They have a strong mission and sense of purpose. There's no other software company like it. And the reason that's important is that they are actually solving problems for their customers. All these companies for the last 3 years have been trying to figure out, what can I do with AI? How can AI make my business better? And most have not really made much of a difference, apart from Palantir's customers that said, Palantir, hey, I'll hand you the keys and about $40 million a year, and you help me make my mission critical systems better with AI. And they're getting results. That's why they keep growing the business, especially the commercial business, at an increasingly fast rate. So it sounds arrogant to say you're an N of 1, but they're delivering behind that promise.
Got to give them props on some level. But having said that, I mean, one of the things that investors have been concerned about is that more than half of their revenues, you talk about the customer base, more than half of their revenues comes from the government. And some might say that's overexposure. How do you see it?
Yeah, but that won't be for long, right? The commercial business is growing so much faster than the government. Mind you, the U.S. government business just grew 66% year over year. It's just that the commercial grew a lot faster than that. So within a few quarters, the commercial business will be bigger than the government business in a good way, because it's doubling every year now, and the government business is growing, quote unquote, just 66%.
Just 66%. Can you explain some more of, like, just translate for us a little bit? We were talking with Romain earlier, and you know, typically I would go to a press release to try to get information, but I don't understand what Alex Karp is saying here. He's the co-founder and CEO of Palantir. He says, quote, Palantir's Rule of 40 score is now an incredible 127%. What does that mean?
Oh, he's adding revenue growth with operating margin. And if you think about most companies, the term Rule of 40 was coined as the trade-off between revenue growth and profitability. And most software companies hover somewhere around that. If they're growing 10%, they have 30% profitability, that's 40. If they're growing 30% and have 10% operating margins, that's 40. So that's the yardstick that the industry has created for itself. And this is the yardstick that Dr. Karp likes to measure, because it shows how much farther ahead the Palantir is ahead of any software company. Again, the second highest company is probably half their rate. So They are growing faster than any software company, at a higher margin than any software company. They are more profitable than even the largest software companies, Microsoft, Adobe, Oracle, Salesforce. they're more profitable than those companies, and they're growing 3 or 4 times faster than those companies. So I think that's what Dr. Karp enjoys pointing out to everybody else.
Is this one quarter, or is there enough there that says to you that commercial revenue growing 137% year over year, that is something that's a significant shift and something that we can assume will continue, or that's what's got to be grilled, with the C-suite on the call?
Well, we think it'll continue, but realistically speaking, we thought 20% would continue, and then 30%, and then 40, and then 50, and then 60. And here we are, they're growing 70%. So we think that, we'd expect that to continue, but it may actually even be higher next quarter. Again, this is when you deliver results at the level they deliver to their customers, customer acquisition becomes a no-brainer, because one CEO and CFO tell another CEO, CFO, you know what, we just handed the keys to Palantir, and they made our business better. And that seems to be working really well right now. So it looks like they should be able to grow at least that fast for the rest of the year.
Is there political risk long term with this company? This was seen last year as part of the Trump trade. And certainly the DNA of this company shares elements with this Trump administration, certain people moving back and forth, certain people in power, certainly. And no question that this administration supports the work that Palantir is doing. What happens when or if this administration changes?
That is a risk, because to your point, there's an ideological alignment. I would say that it's probably not about personalities, because the personalities have changed a lot year to date in terms of who's involved in the administration. Mr. Musk is out of the administration, for instance. But the company, again, I talked about a very clear mission. They believe their mission is to help defend Western civilization. That resonates very well. That's very ideologically aligned with this administration. But to your point, we may have a different president 3 years from now who may have different ideology and may see Palantir as linked to this administration. And that would be a risk 3 years from now if there was to be a change in the U.S. government.
Hey, listen, one of the things, and forgive me, I'm going to spring this on you. You are head of technology research, so forgive me if this isn't, one of the companies that you cover, but I'm sure you have some thoughts.
He's a software guy.
He is. We did get a story that broke across the Bloomberg that Elon does plan to merge SpaceX with xAI. That's according to people familiar with the matter. And this has been, kind of hovering around, I feel like, late last week, and then, of course, this morning. So I'm just curious, it's a deal that could encompass Elon's ambitions to dominate AI and space exploration. Do you have any thoughts on this?
I have a lot of thoughts on it. So we always looked at it as Elon Inc. Elon has different commercial entities right now, but a really unified set of principles and goals that he is pursuing. And at some points, it made more sense for him for Tesla to be public and for other companies not to be public. The capital demands of the xAI business are very substantial. Let's not forget, he needs to build data centers as fast as Google and Meta and Amazon and Microsoft are doing, and he doesn't have the cash flow that those companies have. So he needs more capital. SpaceX right now is a much better situation to raise capital. So is Tesla. I would think of the end game as having one Elon Inc. So xAI and SpaceX merging would actually lay the groundwork for him to merge that into Tesla as well. Because again, the goals are the same goals. We want to send Optimus robots to Mars so our Neuralinks can control them and we can do the searches on Grok. That's Elon's plan. Right now it's several commercial entities, but long term he has the one vision.
Yeah.
And it makes more sense for him to just fold that into one entity, the entity that can get him the capital to pursue those opportunities.
Which really kind of fits into a conversation we had with Ross Gerber earlier. He had put out something on of Gerber Kawasaki owns these companies, the private Elon entities as well as the public. But he said X was out of money.
He just said this on X, by the way.
Yeah, he said this on X. And he said,
we should note.
X was out of money, merged with xAI. xAI was out of money, merged with SpaceX. SpaceX out of money, merged with Tesla. When they're all out of money, and then it's like ... But it's interesting how you say that that SpaceX, we constantly talk about the value in this company, right? And Tesla, increasingly, everyone's saying, well, the value will be in the future, whether it's robotics or autonomous driving and autonomous systems, if you will. And so how you're saying Tesla's where the value, SpaceX is the value, so you can raise money off of it and then eventually fold it all into one, into that Elon Inc. That's what this is, in your view.
That's what it looks like to us. Again, for him, commercial entities are just a way to get to the goal. And he'll keep them as separate as long as that's the best way to pursue the goals. But right now, SpaceX is the most valuable property in the sense that there's nobody that does what they do, and there isn't going to be anybody that does what they do for decades. So that creates a tremendous amount of economic value that he can raise capital with. And on the Tesla side, the stock is still very well priced, considering, again, the car business. You just talked about this earlier. The car business is a declining business.
Yes.
Yeah.
We're done with that business. Now we're doing self-driving and we're doing robots. And again, it's the same thing. All this information that he's capturing through self-driving won't just make a great business, will also help Optimus robots function in the world, because they'll have those billions and billions of hours of video to analyze in order to help those robots function in the real world. So again, a business where he's at least multiple years ahead of anybody else, at least in the West, at least outside of China. So there's a capability to raise capital there. He's just going to go where he can raise capital to stay competitive in AI. Because again, that still feeds into Optimus robot functioning in the world, because the Optimus robot will need the best AI model in order to do that. It's all one thing to him.
Gil, sit tight for a second. This is fascinating. And hopefully our Ed Ludlow has been listening as well, who covers Tesla and Elon closely. Gil, don't go anywhere. Ed Ludlow, of course, co-host of Bloomberg Tech on Bloomberg Television. Ed, I hope you have been listening. I'm just curious, this story by you and Lauren, that Elon does plan to merge SpaceX with xAI, according to folks familiar. Get us up to speed on the latest.
Yeah, so our understanding is 2 memos went out. One from Elon Musk to staff at SpaceX and I think at xAI as well. And it basically explains that the merger or combination is happening. And the rationale is, vertical integration. This is something that's kind of been hiding in plain sight, right? And the three of us have discussed quite a lot in the last week. But the idea, SpaceX provides the launch capacity, and together the two companies design satellite form factor data centers, very focused on inference. And so, the models that xAI is developing can be run in space. And, maybe if we have time today or later in the month, we can talk about the technicalities of why space-based data centers are supposed to work. Then separately, Brett Johnson, who is the CFO of SpaceX, has sent a memo out explaining that the combined entity of SpaceX and xAI has this valuation of $1.25 trillion, which the math kind of maths, right? Because SpaceX's last valuation on the 10 was $800 billion and xAI's last on its primary was $230 billion. And the only thing to add to get you up to speed, I guess, is that my understanding from sources and throughout this whole process is that this IPO is still on ahead. Okay. It's still going in June.
Ed, should we think about Tesla joining the likes of SpaceX, xAI?
This is the hypothesis, right? That in the end, in the long run, that it becomes a conglomerate, an Elon Inc. What we reported at the end of last week was that there were 2 distinct scenarios being considered: a combination between public Tesla and private SpaceX, and then a completely different and alternative scenario of SpaceX and xAI. And obviously, this has moved quite quickly. SpaceX and xAI, based on the reporting of the last 30 minutes, is happened. It's done. My understanding, though, is that there are a lot of concerns, particularly from some of the bigger SpaceX investors, on SpaceX combining with a company that's losing $1 billion a month and has a very large pile of debt on its balance sheet, and that those investors saw the economics of the Tesla tie-up being much more sensible. But then, the thing is, right, the unanswered question was, well, hold on, if SpaceX were to merge or reverse merge or whatever the final transaction would be with Tesla, then there wouldn't be an IPO, right? So the whole point on the IPO is that, even now this xAI combination's done, they're going to need tens of billions of dollars literally just to buy the GPUs, because the GPUs that go into space data centers, as abstract as that sounds, are the same as those that go into a data center on Earth, and they're going to cost a lot of money.
So Gil, Ed Ludlow, sit tight for a second. Gil Luria, I want to bring you back into this, head of tech research and managing director over at DA Davison. So Gil, Ed made the point that SpaceX investors might not be so happy. xAI losing $1 billion a month, pile of debt on its balance sheet. So how do you see this? Do you still see a SpaceX IPO, or no, that they ultimately just fold Tesla in? It changes the dynamics of what this company is too, or fundamentals.
Yeah, it could be a matter of sequencing. I want to add a couple of things here. One is Elon Musk controls these entities, and he set the price. So that valuation we just talked about for xAI is a price that he set when he merged X and xAI. The SpaceX investors may feel like that's too high of a valuation, especially considering they're losing $1 billion a month, and therefore they'd be getting the raw end of the deal. These are things Mr. Musk controls. He can give a better deal to SpaceX shareholders, especially if the goal is ultimately to IPO this, which is it is still very much possible, is to IPO the joint entity. He can just adjust the relative valuations. Again, he's in control. He can adjust the relative valuations to make it so SpaceX shareholders don't feel quite as bad about it. And then position the overall financials in a way that would still make for an attractive IPO. And then again, he can still merge two public entities together. He's done that in the past too. Remember, there was a Solar City before there was Tesla and Solar City.
Yeah,
right.
There was a Solar City as an independent private
family affair also.
Company. He merged those two.
Yeah.
So it's just one path towards colonizing Mars.
Gil, good place to end it on. Carol, how's that for a guy who doesn't cover Tesla?
Oh my God.
That's pretty awesome. Gil Luria,
so great.
Managing Director and Head of Technology Research at DA Davison and Company, joining us from Portland. Gil, thanks a lot. He's a software guy, but obviously watching what's happening over at Elon Inc. and xAI closely.
Ed Ludlow still with us. Ed, come on in on what you just heard and any other thoughts that you want to share with the Bloomberg audience.
Yeah, I mean, again, what we're reporting is our best understanding from sources and the comms that we've seen, right? And it is, that SpaceX and xAI are combining, and that the valuation is $1.25 trillion of that private company. And my understanding and Lauren's understanding and those other reporters that have been on this for the last some days is we're still headed towards a significant IPO at the midpoint or later in this year. The one thing I would say is, Max Chafkin and I wrote about this in some detail in the August edition. August seems a long time ago, but the August edition of Businessweek. Musk knows that the combination of all of his companies is going to face a serious hurdle, regulatory hurdle, on antitrust and review. But at the end of the day, the mission statements of those companies are now much more closely aligned in what he calls amazing abundance. But yeah, I don't know how much of this is a surprise.
Yeah.
What? Maybe this is a stupid question, but I'll just go there.
Go there, Carol.
So why on antitrust? What is the concern?
Well, the main thing, I suppose, is that they occupy the entirety of one single market, which would be data centers in space, for example.
Yeah.
I think one thing we're going to, again, I go back to some of the other concern that this is not sort of a plan that is universally adored by all the people that are invested in Elon Musk's various companies. And the one thing I would say is that Elon Musk does not hold the majority of SpaceX financially speaking, but he does have completely outsized voting power due to the multi-class share structure. And so in the first instance, this is being done. But I think it's just a very simple terms that having every single branch of the Elon Musk universe under one holding company is going to be difficult to do. And generally speaking, there's an acknowledgement in the market that that's the case.
Hey, Ed, one thing that we've been hearing over and over again since last week is that Tesla's car business is in decline. And now there's this view, hey, don't look at the cars, don't look at the number of cars that we're selling. Look at the areas of growth for our business. Mm-hmm. Do you agree that that's the right area that people should look to?
Well, that was... it was certainly the reaction of the market from Tesla's earnings last week, right? The car business, we knew about the sort of deliveries picture because they come out ahead of earnings, and investors largely looked past that to this next phase that Elon Musk was talking about. The main issue is that tied to Elon Musk's compensation package is still the mandatory goal of 20 million EVs to consumers a year.
Yeah.
Oh, okay. Yeah.
So he still has to sell them. It's not like they just stop doing it.
But they can be robo-taxis.
So it's about...
yes.
Was there a couple metrics to it, like market value and so on and so forth? Like, does he have to get all of these metrics in order to get that pay package? I was thinking about that too. Yeah.
So it's why, even in the context of what we reported about the idea of a Tesla and SpaceX combination, the compensation package is worth studying. Those goals that the board sets for Elon Musk aren't either or. Okay. It's not this one, but not this one. It's all of them. They're all mandatory and correspond to one another. So, Tim is right that robotaxis are part of it. One of the goals was to build the robotaxi fleet to a certain size. The other was to hit a certain number of subscriptions for full self-driving. But still is the requirement to sell 20 million consumer EVs. And so, what we learned about through the capital expenditures commitment that Tesla has is just where it's emphasizing. And clearly, the consumer car is not their biggest point of emphasis right now going forward.
We know you're not feeling well. We so
appreciate it. You sound good, though, Ed. You sound good.
Yeah, we are so appreciative of getting your voice on this and all of the reporting that you've been doing, even when you're not feeling well. Ed Ludlow, thank you. Feel better.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, so we have seen dollar weakness, though, for a while, but it's been an interesting week, no doubt to say the least. All of this got us wondering about what is really the trade for the U.S. dollar short and longer term. To do that, back with us is Jayati Bhardwaj. She's Director of FX Strategy at TD Securities. She joins us in studio. I'm not jealous of you having to figure out the dollar trade right now, the position you're in. We've seen dollar weakness for a while. Yep. Last week was interesting, right? We had the president talking down the dollar over the last week or so and then kind of backing off of it, right?
We have a strong dollar policy.
Yes.
That's the one line we keep hearing.
And the way the appointment or the nomination of Kevin Warsh to head up the Fed, and the thinking is maybe more hawkish, so maybe more inclined to fight inflation, which could mean higher rates, which would be supportive of the dollar. Is what we're seeing some strength today in the dollar index a short-term trade in your view before it resorts back to some more weakness?
Absolutely. It's been quite the start of the year. You're absolutely right. It was a reversal of the debasement trade, let's say. The debasement trade has had the strongest legs in precious metals, and the second asset class after that, which has been pricing that, is FX. Bond markets and treasuries, thankfully, have been spared from that, which is why moves in treasuries have been a lot more contained. But precious metals, followed by FX, have been the largest absorber of the debasement trade, which with Kevin Warsh over Rick Rieder, you got a little bit repricing off, which is why precious metals fell and the dollar, rallied a little bit. Tactically, we do think the dollar has room to continue to strengthen a little bit. January and February tend to be very strong from a U.S. data strength seasonality. So we do think Jan-Feb, if the focus remains on U.S. data, you could see a little bit of a strength, but any such strength we think will be very temporary.
So you think the debasement trade has come and gone at this point?
It's not seen the end of it's not seen the end of its last legs. Just think about about the number of Supreme Court decisions which are still pending. Kevin Warsh markets are assuming is going to be hawkish, given that he used to be, in his erstwhile Fed days as Fed governor, he used to be hawkish, talk about cutting down the balance sheet, but he has now been appointed by a president who wants him to slash interest rates heavily. So we still don't know to this date if Kevin Warsh will play that hawkish profile which markets are expecting him to play, or will he have to, balance the two profiles? He cannot just bite the hand which is feeding him, right? He cannot just talk about a hawkish policy right off the bat. So,
why? Well, it's interesting that you say that, because we did have the president at that dinner in Washington. I think press weren't open, but he apparently made some comments about Kevin Warsh and maybe, having to sue him or go after him. So, I mean, if we should assume Kevin Warsh is Fed chair, is he going to be one that is going to be constantly on the radar of President Trump, especially if he is more hawkish?
Unfortunately, that's the job. Any Fed chair is going to be on the target of Trump, whoever it is, and now it's going to be Warsh. Warsh will likely be nominated. We don't think it's going to go through any problems in his nomination going through. The next big question would be, would Chair Powell then step down? Odds of Powell stepping down have increased a little bit, but that's under the same assumption that markets think that Warsh will be reasonable, going in line with data, and nothing to do with what the administration wants.
It's almost like, does the adult in the room need to be there or the babysitter need to be there, right? To some extent?
Yeah, absolutely. And we don't even, even outside of this, we still are pending decisions on Lisa Cook's trial,
right,
on IEPA being legal or not, on Powell, on the renovation charges on him.
But don't you think is Powell safe as a result of Senator Tom Tillis?
That is the assumption, because a lot of senators, including him, have come out saying that we're not going to approve any nomination for Fed chair unless you get that sorted, which definitely does increase, thankfully, the odds of that being, swamped out and that basically being done and dusted. And that's why also polymarket odds of Powell stepping down as Fed chair have also, increased a little bit. But it all depends upon the timing. I think timing is very critical, but the number of cases are still many-fold, which is why we don't think that the dollar is out of the woods yet.
When you said the debasement trade's not over, is it largely because of the U.S. fiscal house, the U.S. White House creating kind of uncertainty on a geopolitical level? Is that part of it?
It's manifold. That is definitely one big aspect. The second big aspect is that the dollar as a safe haven, that's no longer working out to be true. The dollar, in fact, has been behaving like a high beta currency. Its correlation with rates is broken. Its correlation with equities is broken. And now the global portfolio manager or the global foreign investor is now looking to invest outside the U.S. I'm not saying they're selling U.S. assets. They're not. But the marginal wallet, they're now allocating to commodities. They're now allocating to global equities outside the U.S., right, which is also weighing on the dollar. And the last thing, which I think is really playing out here, is that the world outside the U.S. is holding up really well.
Yeah, it's such an interesting story in terms of what's going on outside the United States. JT, thank you so much. Really appreciate it.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I want to bring in Paisley Nardini, Managing Director and Head of Multi-Asset Solutions. At Simplify Asset Management, the firm has more than $12.46 billion in assets under management. She joins us from California. Paisley, how are you?
I'm great. Thanks for having me back.
Yeah, thanks for joining us. I just want to start with the rotation. I'm looking at the Russell 2000 right now. It's up, year to date, more than 6% already, whereas the S&P 500 earlier in the session was up just about 2% year to date. That's nothing to shake a stick at, 1.9% right now. But the rotation to small caps, is that something you see continuing throughout this year?
I would say initially my reaction to that is no. I think what we've seen is kind of these short-term blips where we'll see small cap stocks take the lead. I think there's so many pressures and headwinds for small cap stocks ahead. Just the flows that we see into passive management alone, I think, is enough to kind of curtail small caps run up from here. But I do think some of the catalysts that we've seen in some of the rotation year to date is eye-opening. I think a lot of investors and allocators were kind of waiting until the new calendar year to start making some trade rebalances within their portfolios due to tax reasons. I also think investors are really searching for value in this marketplace. And so thinking about valuations in small caps and some of the other sectors within large caps as well has been kind of what has propelled a lot of these kind of non-tech, non-discretionary stocks higher this year.
So where do you find that value?
As we're seeing today, I think some of the small caps, more of the consumer staples.
Okay.
I think even within energy and industrial stocks, just from a pure valuation standpoint. I do think, though, again, these are short-lived. I think where we're seeing productivity, where we're seeing margins, where we're seeing high free cash flow from a corporate perspective is still in a lot of these tech-heavy, more asset-light companies. And so I think this is kind of that short-term blip. And we do tend to see this play out. We saw this several times last year. It lasts a couple weeks, and then markets really go back to the trade they're comfortable with, which is the AI tech-focused trade.
That's what I wanted to ask you. I always love flows of money, Paisley, and kind of where they're going out of. And I'm just curious, we're now a month into 2026. We've had a Fed decision. We've had some policies, some volatility once again out of the White House. We're now thinking about midterms. Where are investors wanting to place their bets right now? Where do they not want to?
I think the volatility that we just saw towards the end of last year, although it was, a pocket of the metals industry, which a lot of allocators don't even have, allocations to within their portfolio, I think it was a wake-up call of just the fragility of the system. I think when we see these parabolic rises, as we have seen in the past, and the Mag 7 type stocks, it's a good reminder for the importance of diversification. And so I think investors are coming into 2026, seeing some of those unique tailwinds last year, the themes behind the debasement trade, de-dollarization, and seeing more of the play in the international space within equities and the importance of alternatives in a portfolio. And so I do think that theme will persist throughout this year. And again, some of that fragility we saw in markets over the last, 2 to 3 trading days is a really good reminder that markets don't always run up higher forever.
No, totally get it. But it's interesting. I can't tell you how many times we've had conversations over the last 3 years of people saying, it's time to broaden out, get off of the Mag 7 and the big tech trade. That was really the place to be in a large way over the last 3 years. I was just having a discussion with someone about that, that their investment advisors are always saying diversify, diversify. And yet, do I wish I was all in gold and silver probably last year or gold? Yeah, I probably wish.
Why weren't you?
Well, I wasn't, because I do this for a living and I need to, set it and forget it to some extent.
And you can't see
we actually see the metal space broadly very underallocated to. And so I think what hopefully will happen is this flush out of the system and some of these levered plays that were in the market, that goes to the sidelines and some of the real money starts to come in and understanding the importance of commodities. But going back to your point on this continued topic of how do we diversify beyond the market cap, despite the fact that that market cap passive within equities continues to run up, just the last 3 months have been a really good observation period where we've started to see a lot of dislocation in that Mag 7. And so I think we'll start to see this reshaping of the leaders within the market cap space.
So I'm curious, though, too, when you say, the outperformance that we've seen in foreign markets or markets outside the U.S., and I totally get it. We talked about it a lot last year. Having said that, when you say to a client in terms of portfolio management, you need to diversify your exposure, how much do you move away from the U.S. and into some other sectors, whether it's European markets, whether it is gold? How much? Is it a small portion that you're suggesting, or, is it a bigger move away from the United States?
Yeah, I think there's still a key importance of having a bit of a home bias as a U.S. investor. I think a lot of the strong growth within earnings as it relates to the equity market still resides within our borders. So it's not an all-in or all-out type trade. And if we just use kind of the broad market cap passive indices that are available in the market, thinking the U.S. is anywhere from around 65, maybe almost 70% of that market cap, that leaves another 20 to 30% in non-U.S. equities. And based on the advisor portfolios and allocator portfolios that I look at, I think investors are still a far cry from that 20 to 30% in international equities. So if they have a representation of, say, 10%, moving that up closer to 20. So it's really at the margin making some of these tweaks. It's not a complete portfolio overhaul.
What about within fixed income allocations, just in the last minute that we have with you? Where do you want to see people this year?
Well, we saw duration play out last year, despite everyone hating on bonds for some time. I do think starting yields and the Fed nomination, expecting rates to cut by another maybe 25 basis points cut this year. Having duration in portfolio and interest rate risk could benefit investors, but I think it's really important to be cautious within credit-sensitive sectors, just given where we are seeing historical spreads at tights today.
Wait, where are they? What areas are curious or concerned about?
Yeah, I mean, high yields,
just quickly. Yeah, high yield.
Yeah, high yield spreads are at historical tights, and so you're really taking on a lot of risk in a portfolio to not be compensated for it. You can still access those parts of the market to get attractive yield and distribution, but having a hedge within your portfolio, I think, is really important. And then looking at some areas in the market like agency mortgages, it's really little to no credit risk and getting a yield pickup over treasuries.
No, interesting thought when you've got, we had a headline today, Oracle selling $25 billion of high-grade bonds for AI funding. We see that trade over and over. Good stuff. Paisley, thanks so much. Have a great week. Paisley Nardini, she's Managing Director, Head of Multi-Asset Solutions at Simplify Asset Management, joining us from California.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.